Question is that the bill be now read a second time. Mr. Liang.
Mr. Speaker, sir, Singapore has always been an attractive destination for foreign investments, both direct investments and financial investments. In 2020, despite being an uncertain and challenging year, EDB was able to attract direct investments commitments of $17 billion, very much keeping up to the trajectory for inbound direct investments. On the financial investment front, the Singapore dollar-denominated equity and debt markets assets continue to attract significant capital inflows as investors take comfort in our solid sovereign ratings, our strong economic fundamentals, and political stability. Coupled with the country's net positive savings, our local dollar persistently faced strong appreciation pressures. In order to manage the Singapore dollar within a tolerated trade-weighted band, MAS will often need to intervene in the foreign exchange markets to moderate the rise of the Singapore dollar, and as a result, accumulates a growing size of foreign currency known as the official financial reserves, OFR. To many jurisdictions, this would be an enviable position or a happy problem to manage. It demonstrates the international market's confidence in the Singapore economy, the securities that we issue, and the Singapore dollar. While this may be a happy situation, we need to manage a couple of related issues. Firstly, how much of the OFR does MAS need to conduct monetary operations effectively and to ensure price stability and market stability? And in excess of that OFR, what do we do with the accumulated OFR which are in foreign currencies? How can we derive decent returns from these accumulated funds? Firstly, on how much of the OFR should MAS hold? The Minister just mentioned that MAS currently, as at November 2021, holds $566 billion of OFR, and this is quite a significant increase from the year before of $479 billion in December 2020. That's an 18% increase. The current level of OFR represents more than 100% of the size of Singapore's GDP. The Minister mentioned it's about 110 or 111% of the GDP. And MAS determines that the optimal level of the OFR should be about 65 to 75% of the Singapore's GDP. I suppose this takes into consideration the size and the daily turnover of the Singapore dollar traded in the markets and the ability to buffer against large and sudden outflows of capital that could result in extreme volatility in the Singapore dollar exchange rate. To serve these functions of managing extreme volatility, the OFR are kept in cash or high-quality liquid assets so they can be drawn upon immediately when the need arises. Whether in absolute amount or relative to GDP or on a per capita basis, our OFR stock will be among the highest in the world. So there are no real merits to further add to the stock of the OFR if the optimal level is already more than adequate to manage monetary operations and to tackle markets' tail risk events. Besides, we also have the two other pots of national reserves managed by GIC and Temasek, which could further shore up confidence and strength in the Singapore financial position. While the OFR amount is regularly published, I would like to take this opportunity in this second reading, to ask the Minister to share on the framework under which the OFR are managed. What are the liquidity and the risk guidelines? And is there a target returns for MAS in managing the OFR? How often does MAS review the optimal level of the OFR to hold? And do significant economic or market risk events such as the regional currency crisis immediately trigger upward adjustments of the OFR? So this bill empowers MAS to subscribe to the RMGS issued by government in consideration for the OFR to be transferred to the government and thereafter for GIC to manage. With this transfer, the excess OFR can be invested in portfolios with longer-term horizons and relatively more risky assets so as to achieve higher returns than what MAS can deliver. This instituted transfer mechanism sharpened the clarity of the role between MES, which primarily focus on price stability, and GIC, which invests for longer tenures and take on higher risk for higher returns. So on this aspect, I have two further questions for the ministers. Would the excess OFR that's being transferred to GIC be managed as a segregated pot from the rest of the financial reserves that the GIC manage? My second question is, would the returns from these excess reserves contribute to the annual NIRC? As to whether the government could use the IMGS proceeds to finance government spending, I'm satisfied that the current legislative safeguards, namely the GSA and the current amendments to the MES Act, are adequate to prohibit that. And in addition, the Constitution also requires the government of the day to balance the budget over its terms of the government. So, sir, with that, I support the amendments.